From the morning reading, small stocks start to show leadership. Dollar nears 13-year high as euro weakens. Commodity deflation holds bond yields down. So do negative eurozone yields. Currency hedged EMU iShares offer a way to buy eurozone stocks without the negative effect of a weak euro. Rising dollar hurts emerging markets and helps U.S. outperform rest of the world. Home improvement and home building stocks advance. The dollar nears a new high as the euro weakens. One of the big intermarket stories is the continued strength of the U.S. dollar. The monthly bars show the U.S. dollar index ending the week just shy of a new 12-year high. One of the big reasons for that is the continued drop of the euro. The monthly bars show the euro on the verge of hitting a new 12-year low. Although all other major currencies are falling, the euro has the biggest influence on the trend of the US dollar to the tune of about 56% contribution. The main reason for the opposing trends and expectations for the Fed to start raising rates in December, while the ECB is expected to announce more monetary easing, possibly as early as this weekend. That has a lot to do with intermarket influences. For one thing, the strong dollar is keeping downside pressure on commodity prices and stocks tied to them. Commodity deflation, in turn, is helping keep global bond yields down, including treasuries. Negative yields in Europe are also helping to keep treasury yields down. That helps explain the recent drop in the yield curve. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:11 a.m. Central Time, and I'm recording this in preparation for the market day of November the 30th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. Get back into our routine here after the 4-day holiday. On the U.S. broad market indices are all slightly up, not too much. On the S&P futures are 3.5 points or less than 0.2%. The Russell's up the most robust at about 0.4%. NASDAQ is up almost 1/3%, and the Dow is up about 0.2%. In terms of other U.S. futures, you have crude oil up about 0.86%, euro down about 0.25%, bonds essentially scratch, and gold also essentially scratch. Note that bonds and gold are on a new contract, so be sure that you're trading with the right contract and where the volume is. On gold, that would be the G16, and bonds, that would be the H16. In terms of overseas action, China's up about 0.25%. Hong Kong is down about 1/3%. Japan's down about 2/3%. Germany's up about 1%, and the United Kingdom is essentially scratch. In terms of macroeconomic reports for this week, a big schedule, and in fact, I don't even have enough room on this report for tomorrow. It's just today being represented here. In terms of the U.S. components here, you got pending home sales, and that would seem to be it for the U.S., but you could see a very busy macroeconomic report day around the world. In terms of current volatility conditions, short-term VIX is at a 14.35. IV percentiles, a 16 on the S&Ps, a 9 on the Russell, a 12 on the NASDAQ, and a 17 on the Dow. No standard deviation moves were put in, and this represents Wednesday's action. Friday, just in verbal reference, is also a very, very small candle. So we've gone since early in the trading week last week since we've had a standard deviation move. So as you would expect going into the holiday, action got quite a bit quieter. and volume was also, generally off. Though I will say that there was more volume going into the holiday weekend than we many times would see. But bottom line is, it usually is nothing of significance at the very least going into a holiday period. Now you see the SPX here. This, of course, would be Friday's candle, Wednesday's candle. So the action last week, you had a bit of a range earlier in the week, but essentially the entire trading week ended up with small bodies and really didn't achieve anything. And indeed, if you look at the open on Monday versus the close on Friday, didn't really achieve anything of note from a chartist standpoint on this chart. Now today, of course, we'll have all the market participants coming back, and volume should be back, and we should get more of a feel as to which direction the next leg would likely be. The expectation at this point would be that we should make our way back to the all-time highs, at least to this swing high here at the 2117 area of the SPX, and then on to this 2133 area at some point between now and Christmas. Now, not likely to be a straight line. We could have retracement action coming in here before this sets up and legs back up. So that's best hypothesis at this point based on what my opinion of what the charts are telling us. In terms of the Dow, very much similar action here. Nothing of note with recent candles. NASDAQ, a little bit more action on that day earlier in the week, bigger body, but still relatively just kind of an inside week for the NASDAQ. And then the Russell. Russell was the outlier. Russell was decidedly bullish and kept that stance all week. Every single one of these candles pretty solid, bullish bodies. I can't even really argue that Friday, even on partial day and so forth, that this body was a lack of momentum for the amount of time the market was open. This was actually a pretty robust body. And you also note, look at the former highs there. Friday's action broke the former swing high on the Russell. So I'd like to see this confirmed today with all market participants. But if we get a close above this level right here, we'll call it 1200 on the rut, that would be pretty significant, and we would then expect that the Russell, while it may retrace at some point, would start to make a move to catch up with the other indices and move back up closer to the all-time highs up into this area. So the Russell continues to be, in the short term, relatively the strongest of the four indices. In terms of the volatility, you see volatility kind of ebbing off all during the holiday week. Again, we'll know more with today's action. Bonds, also relatively quiet last week. Had the gap several trading days ago, and it's basically been in a small consolidation pattern since that time. Okay, let's get back to our daily report. And there's a few changes here, but not too much since the last time we were together. We're still in phase 2, trend reversal, a bullish intermediate term phase opinion. IBD status also a bullish pattern with confirmed uptrend. Accumulation distribution score for the S&P is a C, the NASDAQ also a C, so market breadth continues to be a bit of a concern. GMI index is a 6 out of 6 with the buy signal since 1019, though that author remains largely in cash. Primary market condition remains a neutral bear, and indeed when we go to the decision points charts from stock charts, we see on the 3 different time frames we continue to have this really messy combination. Mixed signals in the short term, mixed signals on the long term, but steady eddy bullish signals on the intermediate term. When you put all this together, the consensus is that we are in a transition pattern waiting for resolution and for these time frames to come together and stack, either all bullish or all bearish. Bias would be to the bullish side, and that's kind of where that sits at this point. Intermediate term market posture still very bullish with an upslope sentiment. Position sizing opinions on both systems are at 100%. In terms of that intermediate term market posture, you see all four indices are very bullish, so no concerns from that area. The overall hedge warning status is a level 0 plus, which is normal with some elevated risk conditions. And amongst those elevated risk conditions would be the fact that we have those mixed signals across the different time frames, that lack of a stack. We also have our distribution day count remains borderline high. We start the warning level at 5, and both the S&P and NASDAQ is currently at 5. Skew also retains a very high elevated stance and running about a 12% probability of a 2 standard deviation move in the next 30 days. I would not be at all surprised if we might not see that here at the beginning of this week, Monday, Tuesday, Wednesday, as all the market participants come back, and we're likely retrace some of the recent action before moving on. So this wouldn't be entirely surprising. In terms of new highs, new lows from Wednesday, 225 and the new highs, only remarkable in that it's about 3 times the new lows. In terms of intermarket risk aversion indicators, we do have an increasing warning here. We have 4 of the 5 now flagging as risk off. In terms of special opinions, we are cautiously bullish, so that combined with the fact that the volatility is within the acceptable window, everything is a go. Really, it comes down to just how aggressive your particular chart, your particular underlying is, as to what defensiveness you might want to take. But all strategies should be on the table, should be able to use a ratio of out of the money, in the money strikes on your covered calls, a ratio of higher beta, lower beta. Also consider legging in defined risk positions, all the usual defensive postures that we talk about here on a regular basis, to be able to account for the level of aggression that you wish to take while this market is still in transition. And you should always have that in the back of your mind as you're setting up and constructing your trades, that this is not a healthy bull. This is bullish on the intermediate term, but it is not a healthy bull market. A healthy bull market would have broader participation and would have those time frames nicely stacked, short, intermediate, and long, all agreeing that we are in a bullish posture. So keep that always in mind. In terms of sector-specific market postures, you see that everything looks pretty good at this point, with only utilities being relatively weak across all the different time frames. In terms of percent change, again, this is Wednesday's action. Healthcare, consumer discretionary, consumer staples, and financials eking out positive days. Also, we'll mention the relative rotation graph. Again, this is just more evidence that it is not a super healthy market. You see most of these are tailing down, while there might have been, IYR and KRE. Some of these are XSD, some of these sectors. So semiconductor, XSD, IYR, of course, is real estate, and then regional banking would be KRE. Those are the ones that are, currently in that upper right quadrant. But even amongst those, you got, 2 of the 4 that are kind of green and in that upper right quadrant are kind of tailing down, so they're weakening. So very few of these sectors or industry groups are strengthening, and the KRE would be the example of that happening. So this is hard to make too much of a healthy bull when you see this kind of internal action going on. Well, that should be enough for today. As always, if you find what you're getting from here is helpful to your trading, we greatly appreciate you liking us on YouTube. Subscribe to us on the YouTube channel. Direct comments can be sent to support@falconglobal FalconGlobalTraders.com. In terms of special offers here, we have a number of things going on today. I will spend just a moment to talk about this one. The Cover Call Mastery course, I was working on this course over the holiday weekend and got 8 of the 10 chapters, PowerPoint decks built. So this is certainly coming right along. If you think that you would be interested in a Cover Call Mastery course, send me an email to Steven@FalconGlobalTraders.com, and I'll be sure to provide more details to you as soon as that is put together. I expect that this will be offered sometime in early 2016. One thing I'll make a point about, this is a multi-week, very comprehensive course. You will have a complete cover call trading plan, complete understanding A to Z on how to handle from the selection of the underlying, the strikes, and all the various exit strategies. A very comprehensive plan here. So this is a mastery course, not just a simple little introduction course. You will be much better with your proficiency around covered calls and that strategy as a result of this course, I can quite well assure you. So if you're interested, send me an email to Steven@FalconGlobalTraders.com, and we'll get you more details on that. Disclaimers as always, hit the pause button if you need more time to review this, including the full disclosures that are found at this hyperlink. And we'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.